Well, the S&P 500 rally this year could extend to 7.1% when all is said and done. That's if our next guest is correct. But it will not be an easy ride. Her three themes on the path to get there: moderation, turbulence, and transition. Lori Calvasina of RBC Capital Markets joins us now on the phone. Now, Lori, you can maybe see that we've gotten a little bit of preview of those three themes thus far this year, except maybe moderation. It hasn't felt particularly moderate as we've started off 2020. Are things going to sort of calm down, or at least calm down in patches?
I think they will. And, our expectation is that we would get that bout of turbulence early in the year. I've described myself to clients recently as an airline pilot. You've just gotten on the plane, you're all buckled up, and I'm coming on and telling you the drink cart is going to be delayed half an hour. You're not going to be able to go to the bathroom for a little while because we've got to get through some weather, but don't worry, we're going to get you, to your 3-day weekend or wherever it is you're going at the end of the trip. And that's really how I think about the markets right now. Valuations are very extended on almost any measure. Positioning is extremely euphoric if you look at the futures market. And we're starting to see a little bit of cracks in the market. And I know even today we're having an up day, but frankly, the internals are showing you defensive positioning, communication services, staples, real estate, technology, top 4 sectors. That's not a rip-roaring market. That's a market that's acting like it wants to get a little defensive.
And when you're speaking about defensiveness also, I know you're looking at coronavirus as one of those areas of turbulence, right? That's definitely delaying the drink cart. You also think it is perhaps delaying a rotation out of U.S. equities, right? We've had a lot of folks come on this year and say, we like international, but it's tough to stick your neck out when you've got this big virus going on. So how long do you think that effect will continue and make U.S. equities effectively a haven?
Well, I think that we've got, I think the transition thesis we've been talking about, that feels a little bit on hold at the moment while we're dealing with this virus. I think that is one of the things propping up equities in the U.S. at the moment, is just some of that money hiding out in the U.S. But I will tell you, talking to investors coming into the year, global investors, they very much want to take some of that money out of the U.S. and start to shift it. So I think we'll get back to that in the second half of the year. But to be honest, if you think about the virus and really what it means, I'm frankly astounded that we only dipped 3.1% from sort of the best day in the market this year to the worst day, because companies are being very, very clear in this reporting season that the virus is a problem for many of them. Halfway through, 26% had talked about the virus in their earnings calls, and companies aren't saying there won't be any impact. They're saying they have no idea how to quantify the impact right now, and we'll see in a couple weeks. Earnings expectations are going to have to come down, but the market is not even acting like it's recognizing that fact right now.
Lori, what would you say to some of the guests who've been on our program who had talked about the fact that for the last 10 years, U.S. equities outperformed equities overseas, but they expected that this year that would change? Is that going to be delayed, or do you still see that as a possibility if you agree with them?
I do think that it is still going to be a possibility. And to be honest, I'm not changing my call here. I think the call is just on hold for now. And I think what the virus does is it challenges this whole narrative of an inflection in the global macro. ISM definitely had a good print, but frankly, that was kind of before all these virus impacts. China is really at the epicenter. Europe, to get better, has to see China get better. For investors really to be able to rotate out of some of those safer parts of the market, whether it's geographical, sector, size, you really have to see signs. And what we did sense before the virus is that investors were sort of done with the hope trade. They were saying, we're not going to just take it on faith. We need to see some signs that's actually happening. I don't think you're going to be able to see those signs for a little while. So, I think it's just going to take a little bit of time, frankly.
Hey, Lori, it's Heidi here. So then as an investor, do you put money into the places that have been working? Do you continue to bet on growth? Do you continue to bet on financials which are at record highs? What's your opinion on that?
So, I think honestly it depends on your time horizon. And I think we would all love to be 3 to 5 year investors. And, that's sort of the holy grail. But there are a lot of people, frankly, a lot of people I talk to have to make their year. They have to make their quarter. And the way we came into the year was we said, have your overweights in terms of your sectors tilted towards cyclical. So give a little bit of an edge to that longer term view. So things like financials and industrials were overweight. But frankly, we've also kept an overweight on utilities to kind of get us through these turbulent times, and that's really kind of an insurance policy for our portfolio, so we still like that very much. Now, 2 sectors that we kept market weights on are more oriented to the growth trade itself, not just the defensive trade, and those would be things like healthcare and technology. We think that you have some problems in those sectors. I would say healthcare on the policy side, technology, I think, frankly, is just crowded and expensive. But those are important pillars of the growth trade, and technology in particular, I think if you want to sort of play the short-term growth bounces, is one place you can do it.
Hi, Lori. This is Ramsey from Alex.FYI. I had a quick question about the political climate. So how do you think the sort of the ongoing evolution of the election process is going to be affecting the markets?
So, we did a survey right before the holidays, and to me, this is sort of the rules of thumb that I'm using as we get through primary season. We asked equity investors, if you look at the different candidates on the Democratic side, are they bullish or bearish or neutral for the market? Generally, we found that Bloomberg was viewed as a positive outcome for the market in our survey. Most of the candidates were viewed as neutral outcomes, including Biden and Pete Buttigieg. And then we found that Warren and Sanders were really the only two Democrats that were viewed as bearish outcomes for the market. So, there's been a lot of chatter this week about how Bloomberg was potentially one of the big winners out of Iowa because he didn't spend any time there. I think that could have been, part of the thinking behind yesterday's monster rally in stocks. Just this kind of sigh of relief that maybe one of the candidates that the market likes, came out on top, even though he didn't compete there, and that, the progressives certainly didn't run away with it.
Yeah, not to mention Buttigieg doing a little better than expected, it looks like. Lori, it's great to get some time with you. Thank you so much. Lori Calvasina of RBC Capital Markets.
Thanks for having me on.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.